Every summer, the same thing happens. That rhythm clubs sing stars. Clubs with financial problems spend as if nothing is wrong, and they keep doing it season after season. It's not irresponsibility, it's not coincidence, it's a poorly understood rule that allows this to keep happening. Let me give you an example. A club pays 100 millions for a player, but this year, in the profit and loss statement, it only takes a hit of 20. The money has left the bank account. The risk is still there, and yet the system says everything is fine. This is not magic. It's not cheating. It's called amortization, and it's one of the most powerful and most dangerous tools in modern football. It's summer, the season when players get signed. If clubs had to absorb the full cost of a single transfer all at once, many wouldn't even make it to Christmas. Modern football is not built year by year. Football is a long-term business. It's built with 5 or 10 years in mind. But the problem is that fans and the media think about the next match. And if you lose 2 or 3 in a row, the whole project starts to shake. So clubs juggle. Spend today to win now without destroying tomorrow. This is where amortization comes in. If you sign a player for 100 million on a 5-year contract, you don't spend 100 in 1 year. You spend 20 million per season. It's bashing accounting. Let me give you another example. Imagine a company like Apple that wants to set up its next factory to build this year's new iPhone. You buy the factory, but in your accounts, you don't record the entire cost on the day you pay for it. You spread out over time. But here is the interesting part, because football is not as simple as buying a factory. It has one key variable. Because what if you extend that player's contract? Then you reduce the annual impact. And if you chain amortized signings, you can spend far more than it seems. On paper, everything adds up, and in reality, you are pushing the cost into the future. For years, this mechanism allows some clubs to rack up hundreds of millions in signings without breaking financial fair play, at least under the rules in force at that time. One widely discussed example was Chelsea, because it bet on extremely long contracts to dilute the annual impact for a competitive present while shifting more risk into the years ahead. Careful, amortization, it's not illegal, it's not cheating, it's a standard accounting. The problem comes when it stretches too far, because then sporting success stops being a plan and turns into a gamble. And if the player doesn't perform, if the team doesn't win, the money still had to be paid. Amortization makes everything look stable. It makes the numbers add up. It makes the project feel coherent, but that stability is fragile because it doesn't depend on balance sheets. It depends on the pitch. And when you understand what amortization is, you understand that many big collapses don't start on the pitch. They start in a spreadsheet. So if your team doesn't win, accounting stops protecting you. Pay attention to what's popping up here, because this is not only about transfers. This video is just one piece of the puzzle. Amortization is just one of the invisible rules that hold up modern football. In this playlist, we break those rules down one by one to understand how money starts deciding matches long before the ball even rolls.